Okay, so today is Wednesday, January the 14th, 9:15 a.m. Pacific time. I'm going to go over a few trades that I did here. Initially, I sold an 80-70 put spread in the SPOOs, 0 DTE, buck 90, and this is just to show the timestamps. That was done 7:45 a.m. and 5 minutes later, I made an adjustment, and then roughly 36 minutes later, I made an additional adjustment, and let's quickly go over those. Okay, so initially, let me update prices here to see where we're trading. We're somewhere between 90 and 95, 95 even. Okay, so I sold a put vertical, 68's the handle. I sold the 80, bought the 70, and that was done for a buck 90. It was roughly 7:45 a.m. When I did this trade, or when I did that trade, spot was trading somewhere around even, just a touch over even. And then the market dropped, spot dropped down to about 90, 90, 91. And what I did at that point was I sold a call spread. I sold the 2025, the 69 handle, for 90 cents. I made a small error there, pilot error. I was looking to sell it for a buck, but I inputted the wrong price. I got filled right away, so I knew this fill wasn't the greatest. But anyway, sold it for 90 cents. So we have 90 cents on the 2025 call vertical. We have a buck 90 credit on the 80-70 put vertical for total credits of 280 that I'm working with. All right, prices rallied after that. Spot got all the way up to went from 68.90 basically, almost a 30 handle rally. Got up to 69.18. And when that happened, what I did was, let me go here instead. What I did was I purchased another put vertical to butterfly off half of the risk on the 80-70. So I purchased the 85-80 put vertical for 65 cents. And what that did was eliminate half of the total risk, the downside risk here on the 80-70. Now note that this is a 10 wide spread. So if it goes out at max value or max loss, it would be $1,000 minus any credits received for the trade, which in this case was a buck 90. But since I butterflied off half of it, now the max that this position can lose is really, now you could think of it as a 5 wide from 75 to 70, 70, 75, however you want to look at it. It's a 5 wide, so there's still $500 of risk minus credits received. Now, mentioning credits received, remember that in addition to the buck 90 for the 80-70 vertical, I also sold a call vertical for 90 cents. So there's $280 worth of credits. I butterflied half the risk, the downside risk, by purchasing the 85-80 put spread. So I have $215 of credit in this current structure that I'm working with. On the lower bound risk is going to be 500 minus the credits of 215. So I have 285 risk on the lower end, and that's also the same risk on the upper end. And by the upper end, I mean any price above 69.25, because I have currently short this call vertical. So as time moves throughout the day, the out of the money options are going to start to collapse, and if prices stay somewhere around, let's call it 69 even, then these will go out worthless. These will go out worthless. And if I didn't do anything else, if I didn't make further adjustments, I could keep the credit of 215. So between price ranges, a price range of 68.85 and 69.20, I have a total credit of 215. At the pin, the tail, and the donkey line of 68.80, this 80-70 put spread would expire worthless. So I would collect and keep the entire credit for that. This 85-80 put vertical that I bought would go out at max value. which would be $500. So I would get the $500 from this 85.80 plus credits received of 215. So 715 is the current apex on this position. Adjustments that I can possibly make, well, at this point it's going to be determined by the price path of spot, which is currently trading at about 68.90. Let me take a quick peek here. About 68.90. So for the time being, I don't really have to do anything. Note that the delta here that I'm looking at, the put delta or the call delta, is 50. So prices are going to be trading right around 68.90 currently. And further adjustments will, again, it's price path dependent. So something that I can possibly do is, if this gets cheap enough out here, if and when it does, I can butterfly this off by purchasing the 1520 call vertical. Let's say I paid 20 cents for that as an example. So that would remove 20 cents of credit. I'd still have $195 credit, but this upside risk prices out here would be completely eliminated. And then I'd have another $500 apex here at 69.20, or I can just close this. I can just close this vertical entirely, or do nothing. But again, it depends on where prices go. Right now, they're starting to drop a little bit. They're trickling lower. Looks like prices are near the current lows, and spots trading at about 68.87. So adjustments will depend. Will depend on the price and how much time is left in the day. It's still early, 9:22 a.m. So we'll see. But for now, this is what we have. And quick recap: originally sold the 80.70 for $1.90. Then I sold call vertical up above the 2025 for 90, bringing in total credits of 280. Butterflied half of the risk on this 80.70 for 65 cents. And that's the current position. All right. Thanks for tuning in. Catch you guys next time.